Welcome to the New York Business Leaders Podcast, presented by the Coyle Group. We interview the most interesting and influential business leaders in New York and hear their stories of success, challenges, and lessons learned while building their businesses and personal brands. New episodes drop weekly, so please be sure to subscribe to get updates on your favorite stream. Without further delay, here's your host of the New York Business Leaders Podcast, Gordon Coyle.
Welcome back to the New York Business Leaders Podcast. I'm your host, Gordon Coyle. In today's episode, I speak with my good friend, Scott Mautner, an experienced corporate lawyer who went from a big firm to a solo practice and hasn't looked back. In this conversation, we talk about his experiences as an outsourced general counsel, the middle market M&A landscape, raising capital with clients, and how he documents all of these deals. Great conversation going off in a number of different areas that I think you'll enjoy. You can reach Scott by phone at 914-686-4800 or by email smautner, MAUTNER, at homlegal.com. I'll have that in the show notes and description box as well for you. Finally, if you'd be interested in being on this show, why not contact me? My direct dial is 845-474-2924, and my email is gbcoyle@thecoylegroup.com. I'll put that info in the show notes as well. Thanks for listening. Now on to the show. Hey everyone, welcome back to the New York Business Leaders Podcast. I'm your host, Gordon Coyle, and today I've got my friend Scott Mautner with me. He's never done a podcast, so he's a little nervous. We'll give him a little bit of a break. Scott, welcome to the show.
Thank you very much, Gordon. Good to be here.
Thanks. Why don't you take a couple of minutes, tell us who you are, what you do, your practice, all that kind of stuff.
Perfect. So I'm a corporate lawyer. I do corporate and transactional commercial law. And I represent clients on an outsourced general counsel basis, which means I help them with their day-to-day corporate needs. I do mergers and acquisitions for mid-market companies, any company from about $1 million to transactions as much as $120 million on either the buy or sell side. And I do startup financing. I help companies raise money through the traditional methods, venture capital, angel investing, friends and family rounds, and do that from literally setting up the company to selling the business, as well as all the related documents related to corporate law, which is typically what people think of as shareholders agreements, operating, LLC operating agreements, things like that.
Great. Any particular industries right now that you're busy in?
So I'm industry agnostic, pretty much. Before I started my current practice, I was the general counsel or the head lawyer for a number of technology and media companies. So I have a sort of a deep understanding of technology, electronics, law, privacy policies, terms of use, license arrangements, those sorts of things. But typically the industry doesn't really matter that much.
Okay. In the outsourced GC world, what do those clients look like? Are they different than the transactional clients? What are the kinds of things you're doing for them on a regular basis?
So they're very different. Transactional clients are usually, someone comes to me and says, I want to buy this business. I want to sell my business. How do I do that? Can you get the deal done? The outsourced general counsel clients are clients that I represent on a day-to-day basis. Some go back to the initial inception of my practice at this point, which is 10, 11 years ago. And I'm really what you would think of as a consigliere to the business. So how do I help them? I help them do offer letters, hire, fire, build sales teams, think about non-competes, think about non-solicits, think about who owns the intellectual property for a company, work for hire agreements, those are called. I do corporate governance, again, in the shareholder arena, the shareholders agreements or LLC operating agreements. Some companies want to have day-to-day template agreements. So when they hire a vendor, They sign up to that company's paper when they're signing up customers, get the customers to sign up with their paper. So I perform I prepare what's called a template agreement. So it's really it's a broad range of things. It's problem solving. It's helping operators think through issues, what can happen, avoiding litigation, engaging in litigation, managing litigation, those kinds of things.
Between the two types of the practice, what do you enjoy most?
I think it's nice to build and maintain the relationships with clients. It's a weird thing when I work with a company on selling their business. We work day and night for 6 weeks, and then you almost don't hear from the person again after the deal closes, unless there's an issue, unless they have questions, those sorts of things. So I think the long-term relationships is what's enjoyable, and you get to know the clients and kind of, how's your kids doing today? How's college going? Those sorts of things. But, they're both what's the right word? They're both enjoyable in their own way.
Yeah. Similar to that, my business is similar in that, working on a new piece of business, it's exciting. It's great to build a new relationship, get to know the people in the firm, understand what their risk profile looks like and all that kind of stuff. But then a client that you've had for whether it's 2 years or 15 years, they're experiencing a problem, whether it's a claim or coverage issue or something, and to be able to kind of just work through it and know that they trust you, you trust them. It's nice to have that balance. And I think it's also probably similar that it's also nice to have new things happen every once in a while.
Right. And also from your perspective, and you get to know, at least on the insurance side, you really get into their risk profiles and the problems they have with their business. So you add a lot of value, at least from, giving them real advice and how they can manage some of those things. So it's similar for me.
Yeah. It's a great thing to experience in your business. At least it is for me, and I'm sure it is for you as well.
Yeah, no, exactly. And you have the background to help them, right? Like a lot of times when I'm doing a transactional deal, an M&A or a startup, I have to go back and learn a lot of what's happened before. And it's a very different approach versus, having set up the company 5 years before and know exactly who the shareholders are, and having met all the shareholders and know the different personalities and how you can manage one personality versus the other. It kind of really, it's very interesting to see the different dynamics,
Yeah. And I think being able to provide, like you said, advice, guidance, it's not trying to sell somebody a product, it's trying to help them, which I think it is basic human nature. Everybody wants to help somebody.
Right. Goes against some of the lawyers I deal with, but
we don't need to name any names.
Right, exactly.
But we probably know the same people. What's new in the M&A scene? What is going on? Is it slowed down? Has interest rates affected it? The market?
So interest rates, of course, affects it. I had a lot of clients as the economy was sort of changing the beginning of this year, April, May, June, pushing to close deals as quickly as possible because people saw, inflation taking off. Interest rates were naturally going to have to be hiked to address inflation. So it was crazy, really busy. I think most deals that have been in the works for the year haven't really been affected. There's still a lot of money that private equity funds have, and there's still a lot of money in the marketplace to do deals. So to the extent people are paying cash, it's fine, and there hasn't been really any adjustment. Some of the deals I've been working on where people are getting financing, they're sort of thinking about what valuation is on the deal, either buy side or sell side, right? And certainly on the buy side, if they have to go out and borrow money to leverage the deal up, it's going to affect valuation a little bit. But the economy is still putting aside inflation and interest rates, the economy is still pretty strong. So, the deals are moving forward.
Yeah, I kind of see that from our perspective as well, that we're seeing commercial clients continue to grow their business, revenue growth is up, sales are up, payrolls are up, which is all good news. Now, it could, adjust in another few months, but it's sort of this weird situation, in a New York sort of microcosm that we're looking at, that it doesn't seem as bad as what the news is telling us is going on.
Yeah, I think, unfortunately, middle America always gets hit first, before the coasts a little bit. But I think it's you definitely see the prices going up, and you definitely see costs going up. And can companies adjust quickly enough to address those price changes? It's as employees are getting squeezed, it's going to be tough probably, unless we sort of can level off inflation at some point.
Mm-hmm. Mm-hmm. On the raising capital side of things, what does that market look like in recent weeks?
I've been more focused on the M&A side of the world. I have a couple of clients that are out there looking for money. Like I said, I think there's still a lot of money out in the marketplace. I had a client that just closed $500,000, small round, $500,000 about 5 months ago. But most clients right now, I've formed a couple entities. We're starting the process of looking, but right now in my practice, I don't have anybody actually raising money actively. So, and when I say actively, preparing documents, that sort of thing.
And are the people that are coming to you for fundraising, those are clients that you help form their entities, or you did the M&A work for them?
All kinds of different referrals from someone who's setting up a business, and I want to set up a business, get it structured and move it forward to start raising money. I have a client I've represented for 4 or 5 years, and he's a little bit distressed. And so he's looking at either raising money or selling the business. So that's one thing that's pretty active. I have another client that, like I said, they closed a deal about 5 months ago. And he'll take in a little bit more money maybe, but he doesn't need a whole lot more. So it's a sort of broad range of where the clients come from and where they're, what stage they're at.
Mm-hmm. It's interesting how, a solo practice like yourself can engage in that market and, find money for clients and arrange it. I don't know, is that more common than going to a big firm for that resource?
So the difference is, so when I do, 90% legal and 10% helping clients to find the money, and I have relationships with a number of the angel funds and things like that. The bigger firms, obviously, the biggest difference with the big firms is that they typically get hired by venture capitalists. I don't get hired by venture capitalists. I'm always on the company side. Mm-hmm. And so the big firms, when they have those relationships with the venture capitalists, they can make the introductions directly into the venture capitalists. And that's sort of the main difference. And then, of course, for the big firms, in a lot of instances, you're getting a lawyer who's been practicing 2 or 3 years working on your matter, 85% of the time, versus someone like me who's been practicing a while and doing the work directly. So that's another big sort of differentiating factor.
Mm-hmm. Mm-hmm. So, Scott, I'm thinking, about an entrepreneur, young person, guy, gal, woman, man, whatever, comes to you and says, hey, I want to start this company. I've got this idea. It could be technology based. It could be whatever. How does that process start from like idea to hiring you to documenting it? And then we'll talk more about other steps.
Sure. So the first step is really the main question is whether you're going to bring in outside money to raise outside money. If you raise outside money, you typically would set up a corporation versus an LLC only because LLCs, while they're more tax efficient entities, they have flow through taxation to their members, and most investors don't want to get K1s from investments. They just want to get at the end of the investment, the money you invested and whatever else you get returned to you. So we start with a corporation. A lot of people hear the term C Corp versus S Corp. And an S Corp, you can't raise money through it. There's strict limitations by the IRS about who can be an S Corp owner. You can only have one class of stock, so you can't do what typical money raising involves, which is several classes of stock. And so you typically go to the C Corp route. And then everybody's next question is, what state do I set it up in? Obviously, or maybe not obviously, but Delaware is the one that most people use because it's most friendly, most corporate friendly. And then you take it from there and you set up the corporation. You kind of have to think through the first couple of big items, how quickly people are going to raise money and how many shares you want to authorize, and go from there. But that's kind of the beginning process. The big mistakes that entrepreneurs typically do is they authorize, when you authorize stock, you don't want to issue all of the stock, and you don't have to. So if you set up a corporation with 10 million shares, you typically want to, even if you're the entrepreneur, only issue 1 million or a couple million, so you have shares available in the future. And what typically happens, and I was just on a call earlier today with a client, they authorized 10 million shares and they've now issued more than the 10 million. So we now have to go fix it. And that's not unusual.
How does that happen?
Because people don't realize that
they just keep issuing certificates.
Well, not just that. What they'll do, a convertible note, or they'll do another security called a safe that are convertibles, and they don't count those as part of the number of shares they have to issue.
Oh,
And so they issued to themselves like 9 million shares, and they had like 1.5 million in convertible notes and safes, and they blew through their 10 million. So that's what typically happens. So that's the one thing. The other big mistake entrepreneurs make, two other big mistakes. One is they don't get appropriate intellectual property agreements in place. So if you have a consultant who is doing work for you, you need them to sign what we would call a work for hire or assignment of IP provisions, so that you actually own the work. Without that agreement or those provisions in place, the consultant continues to own his, her, or its work product. And so that becomes problematic, because and what typically happens in these instances, you'll have, an entrepreneur hire his friend who's going to do the software development, and they never put an agreement in place. And then you say, where's the friend's agreement? Oh, he never signed anything. Well, so the friend now owns your entire software business. And so that's another big issue. And the third issue is less common, but I kind of see it, where someone starts a business and they bring in, quote, a co-founder, and they issue them stock in the business. And typically those co-founders, when they're not getting paid for their work product and there's not any revenues being generated, are less all in on the idea than the other person. And after a while, sometimes they walk away. But when they walk away with the shares you have given them, unless you have an agreement in place that gives you the right to buy them back, or gives you some sort of vesting or something else. And I've dealt with, over the years, a number of entrepreneurs that gave away, 10, 15, 20% of their company, and then we had to figure out how to get it back. So that's another big issue. But
in those situations where a founder is bringing in a co, is that usually because they can tap into that person's field of money sources?
Expertise. Yeah, expertise.
Okay, so it's
yeah.
more.
So a lot of times. So maybe let's take you, for example. Someone's starting some new cool internet e-commerce platform and selling insurance. Gordon Coyle has been involved in the insurance marketplace for 30 plus years. He really knows it. He's really smart. I'm going to have him be a co-founder, and I'm going to use him to help me develop the platform and create that platform. So they bring you in as the co-founder, but you're happy to do that when you think it's a couple of phone calls a month, but now all of a sudden they're calling you every day and you're like, look, this isn't what I signed up for. I'm out. Right. Yeah. And so now, though, they've given you 15-20% of their company, and they go to you and say, well, Gordon, I gave you 20% of my company, but like, this isn't the deal. I expected you to work with me to develop the business. I need the shares back. And you say, I'm not giving them the shares back.
Because I know how much they're worth now.
Exactly. And so now the founder has to figure out, okay, what do I do to get those shares back? Do I have to buy them back at fair market value? Can I negotiate a deal to do that? Can I issue myself more shares and dilute Gordon down? What are the different ways that I can kind of figure this out? The easiest thing, of course, is to have vesting and say, you don't vest unless you've been here a while. Or if you leave and you leave of your own volition, you're going to sell the shares back to me at some prearranged value. A lot of times it'll be fair market value, and that doesn't really help. But sometimes it's less, and then it becomes a negotiating process. But
it's so funny that you should bring that up, because I had that conversation yesterday.
Is that right?
Yeah, it wasn't I wasn't trying to be recruited in as a co-founder for a digital broker, but it was to be acquired by a firm that's building this infrastructure technology. And I was like, like so many other conversations that I get hit on with, acquisitions, I'm like, timing's not right. Thank you, but not right now.
Right. Yeah. Right. But, it helps to always listen, because
yep.
You also, it especially on the M&A side, it gives you an indication of what valuations are and where you stand in the marketplace. And those change, obviously, but it gives you an idea of where you stand.
Yeah, and outside of M&A, it gives you an insider's view into what may be coming down the pike. I mean, I sit in my own little environment. I speak to other brokers and associates in the industry on a very regular basis every week. But a lot of my peers are not exposed to the technology side, the fintech side of our business. And there's a lot of interesting stuff happening that could, either destroy or build value within our firm. So you have to just be aware of that to know what may be coming down the pike. So I am grateful that I kind of get looped into these conversations.
Yeah, and your business, in fact, you and I discussed not long ago, M&A rep and warranty insurance. And that's a relatively new product. It's getting more and more popular, but there's still a lot of law firms and brokers who don't know how to use it and haven't ever done a deal involving that. And it's actually a pretty powerful tool for someone who's selling their business, because you're no longer, quote, really responsible for the reps and warranties you're making. There's a insurance company backing you up on those. And the marketplace is such that buyers are still willing to pay for the insurance as part of deals. So that's kind of like a really big benefit to selling, right? Like they're now limiting their responsibility and indemnification obligations, really, except for fraud and the other carve-outs in an insurance policy, to the amounts that is really part of the deductible. It's pretty cool.
Yeah. The other thing I was going to mention is the whole IP part of the conversation. I had Yuval Marcus and his partner Jordan Garner on the show a few weeks ago, and they presented ideas that I never even considered, that like what you're talking about, potential IP conflicts for a buyer or a seller that, we never documented, or we never got a patent on that, or we never got a copyright on that. And it's like, holy cow, you now have a valueless company, or you're buying an asset that, that's a bit of extreme point of view, but But I think so many business people don't have the depth of knowledge around these issues that, becomes very problematic if you're selling or buying a company.
Yeah, unfortunately, what happens, it's the old adage, dollar wise, what penny wise, pound foolish, is people don't want to talk to lawyers because we're admittedly expensive in a lot of instances, but the mistakes you make early on, some can be fixed without too much trouble, others can't be. And getting a half hour or 3 hours of advice may save you literally millions at a later date. People need to understand that if you're dealing with a lawyer who's every time you call them, they're charging you 10 hours of legal time, then maybe that's not the right lawyer. But there are definitely smart lawyers out there that add value and do so in an efficient manner. So it's worth spending the time. And, when you spoke to Yuval, I'm sure, he talked to you about, or maybe not sure, but, there's a lot of times when I deal with new companies, they talk about whether to get a patent or not. And, not every patent is one, issuable, or two, really worth the paper it's written on, because they have to be so narrowly tailored. And also the issue, like when you talk to smart IP lawyers, patents, as soon as you file it, becomes a publicly known document. And so, sometimes just being the first mover and working in stealth mode and kind of launching a product out of the blue is a whole lot more market first mover advantage than filing a patent and spending a lot of time and energy on that. But those are the things smart lawyers will talk to people about and give them hopefully the right guidance.
Yeah, we did talk about that, and we also talked about how if a product, a technology, a process is in the marketplace and it's not patented, there's a window that closes after a certain time frame that you no longer can get a patent on it. And he said he experiences that, and he finds out at the wrong time, like doing diligence on an M&A deal, and it's like, oh crap, what do we do now?
Right. But so it's strange to me, because if someone's never applied for a patent and they're on an M&A deal and they say, oh yeah, we have a patent, I don't know where they get to that place from having never applied or retained someone to do a patent. It's just,
So you were walking through the process of, client has an idea, they want to form a company, you form the right company, incorporate it in Delaware, create all the documents that you need, start to talk about employment documents, intellectual property documents. They get to the point where they're like, okay, I now need X dollars. And I'm always amazed, like, how do they figure out how much money they need to get to the next level? And they certainly don't try to raise all of it in one tranche. How does that work?
Well, it's kind of a balancing act. And so the more you raise at low valuations, the more you dilute yourself. So as the founder, you kind of want to think about getting enough to get you the next stage, but not over raising so much that you've now given away more of your company than you really need to, because now you went from owning 100% of a company maybe to owning 60%, and maybe you didn't have to only own 60% at $1 million. Maybe you could have owned 80% at $1 million and later on raised more money. What the typical advice is, you sort of have to look at the stages. And the easiest world to think about is software, where there's kind of discrete things to buy, to do. So the first stage is usually, how much do I think I need to build out the software, right? And get me to a place where it's done and I can put it in the marketplace and go to a beta, it's called a beta, or get people to sort of adopt it and use it. And so you kind of think about that, and you have to kind of plan, like, okay, I think this is going to take 6 months. I need X number of people to work on it. And, a lot of it's guesswork, right? And the whole idea of being sort of a startup is kind of, keeping the money in house, paying the people you need to pay, but, not going down extraneous roads, and software development always sort of gets there. So when you get, that's sort of the first round. And a lot of people will do a friends and family round. They'll look around and they'll say, okay, I need $500,000 or $1 million to get me to the place. Let me go to my friends and family who have cash and may be willing to support me and like the idea, and raise the money from them first. So that gets you to the point where you now have software that's developed. Once the software is developed, you can go out and say, okay, now we need to do proof of concept and things like that. How much money do I need for that? And some of these things blur into other things. So you might build software and do proof of concept in one sort of tranche, and then the next tranche is launching it and doing biz dev. And that's sort of how you think about how much you need to raise and kind of go through the process. And different companies require different amounts, so I mean, that sort of sounds silly, but it's sometimes a company can build relatively simple software, but it's a marketing play. So they need to raise a lot to do the sales and marketing versus the software. Versus the other thing is someone's disrupting an entire marketplace. So the software is kind of complicated, but the sales are going to be there in theory once you come out with this disruptive type technology. Mm-hmm. So you have to think about that. The usual process is you go friends and family. The next round will be angels and sort of maybe smaller VCs, and sort of those folks are more, quote, professional oriented, and even the angel investors may invest in a whole lot of companies and be able to add value from a experience point of view. And once you go through that angel round, the next round is effectively going out to the VCs and raising what I would call your first series preferred, series A, series B, whatever the angel round came off of. But that's what first round family and friends is usually going to be a convertible note or a safe. Angels will either be convertible or maybe what we call a series seed, which is a smaller preferred round, and then you go to preferred rounds.
And are you pretty involved hand-holding at this point through these funding rounds?
Hand-holding in the sense of helping shape the securities laws affect all of this, right? Because when you make a securities offering, you have to comply with securities laws and provide certain information that's required by the laws and things like that. And now over the last 10 years, there's been a big push in helping companies raise money, and the laws are trying to facilitate that. So now you have crowdfunding financing platforms, you have Series A rounds, which is like a public offering, but it's not quite a public offering. And so on the private placement and doing the documents and helping structure the rounds and creating the rights and those sorts of things, there's a lot of discussion. I don't know that I would call it hand holding, because when entrepreneurs get to that point, they're usually pretty smart and they're usually pretty deeply. And but we definitely talk about rights and obligations and things like that. And how do you want to structure these points? If you're doing a convertible note, what's the interest rate going to be? What is the term on the note going to be? When does it mature? 2 years, 3 years, 4 years? If you mature and you haven't raised more money, how do you want to fix that problem? Because that is a problem. Do you want to convert it into common stock? Do you want to do something? Do you want to have the note holders have the right to vote, or do you have an automatic conversion right? All of those things have to be sort of talked through and understood.
Interesting. And they must be guided as well by a fairly good size accounting firm or financial, advisory firm.
Yeah, I mean, the accounting, on the accounting side for most startups, it's more basic. There's some elections you can do that are favorable, and those kinds of things. I always guide. I don't pretend to know tax. I always bring in smart tax people. So I have the accountants talk through the different elections and think about how to structure certain things, because there are definitely some elections that save founders money in the future, and things like that. So yeah, you typically want, look, if you have significant IP, you're going to have a Yuval Marcus or someone else looking at the IP rights, and should we be filing for a patent, at least maybe a trademark? How are we going to build out are we using open source or not open source? How do we want to deal with that? Accounting, tax, things like that. Those are usually the big players at the beginning.
Mm-hmm, mm-hmm. And then they get through their financing, they build their product, they get to a point of commercialization, materialization, and now they're a going concern. You continue to work with them through that process until they're ready to spin out.
Yeah, we'll say, going back to just like an e-commerce company, I'll set up the privacy policy with them. I'll set up the terms of use for them. We'll talk about how people are going to be buying and selling products through that, if that's an e-commerce site or if there's something else involved, and do we need agreements for that? Should those agreements be, are you signing everybody up online versus old-fashioned paper and having people sign contracts, things like that? And so all of those things need to be thought through. So I'll deal with that as we're bringing in employees, stock option plans. How do you set up the stock option plan? How do you want to build your board of directors? Do you want to have an advisory board? Do you not want to have an advisory board? Because that's very different than a board of directors, right? Mm-hmm. Directors runs a company. Advisory board are smart people brought in to help the officers run the business and develop their business. So how do you want to address an advisory board? Things like that. We talk to employees, option plans, things like that. So all of that is what you do over time.
If there's significant VC capital in the deal, what do they want to see in terms of a board? Do they want a board of directors where they have a seat, or are they good with sitting on an advisory board?
No. So venture capital firms from a corporate governance typically will have one or two board members on the board. Oftentimes there may be two lead venture capitalist firms, and they may both have board members. And what happens is you want to keep the board a manageable size. Like, you really don't want a board greater than 7 people in a startup company. But I've certainly been involved with boards where there's three VCs, and some of the VCs will have 2, or another VC will have 1. So you have, before you've looked at everything, you have 5 or 6 VC board members. And then usually the CEO wants to be on the board, and there may be and the CEO may or may not be the founder at that point, right? So then the founders may want to keep board seats. So, and part of VC deals are really control issues, right? How much control the VC wants to assert over the business, what kind of voting rights and supermajority requirements they're going to have as part of changing. And most of this is more complicated than it is, because most of these rights are negotiated time in and time again. So there's lots of things, but and then the other thing is, usually if the founders are still involved, VCs typically require founders to reverse vest their shares. So you start, if you haven't done that before, you're sort of on a vesting schedule again. And their attitude and venture capitalist attitude, and that may come off snotty, it's not meant to be, but if you're putting a couple $1 million into a company, you want to make sure the founders are sticking around, or you get their shares so that you can bring in someone to replace them if they're not sticking around. Mm-hmm. So that's usually a fairly robust issue as well.
Mm-hmm. Sort of, you can't have your cake and eat it too.
Right. Like, they don't want to give you $3 million and you have you walk out of the business. And you guys figure out how to run the business.
Thank you very much.
Exactly. But it's a big issue because, a lot of founders, by the time they bring in venture capitalists, they may be running the business for 6 or 7 years and not really taking a lot of money out and really, between bootstrapping and bringing in family and friends. And it's been a while since they've made money, and they get to the point where the company kind of is running and they're like, look, unless you're going to pay me a real salary, and, I got to move on here. So, that becomes the discussion. And obviously founders get employment agreements and things like that. So
Do you think a lot of entrepreneurs that are in that boat, like at the very beginning, that they think that they're in it for such a long haul, like they're not going to be making millions right away?
I think so. I've definitely talked. So it's a very different world when you deal with like private equity versus venture capitalists, right? Like private equity, they buy businesses, they may replace the entire management team, but usually when the private equity is going into a business, it's an established running operating company, and they're looking to take it from one valuation to the next valuation.
Right.
And so that's a very different concept. I think a lot of entrepreneurs, when they start out of the box, they think they're gonna, they have to have the belief that they're gonna build a good business. I just don't know if they think it's going to take 3 years, 5 years, 7 years. I don't have that conversation, because you also don't want to be the pessimist in the room and be like, oh, this is going to take you years.
Yeah.
Not. But also, it's interesting. It's usually an entrepreneur's first company that takes the longest, right? I have clients that I'm on their fourth company with them now.
Right.
So
right.
They'll start a company, they'll build it for 3 years, they'll sell it. They'll start another company, they'll build it for 3-4 years, they'll sell it. And, literally my practice is now 11 years since I left my last general counsel job. And I've been with a couple of those people. They're on their fourth company with me.
Yeah.
And, from their perspective, the biggest amount of time is them investigating where they think they can add value and find a niche in the marketplace where they can build a business that's sellable.
Yeah. That serial entrepreneur person is an interesting character. I know I couldn't do it. I just don't have the fortitude to stop if I'm enjoying it. And I've always enjoyed my career. Well, not always.
97%.
I've enjoyed it. There have been my moments. But to stop what you're doing and say, oh, I'm going to start something else. And then 5 years later, this has been great. See ya. I'm going to start something else. I don't have the mindset for it. But
well, some people don't. Like one of those people I work with, he recognizes he's good in the first 4 or 5 years, but he's not a long-term operator, right? He doesn't want to. It's different managing a business day to day versus growing a business, and he doesn't want to have that management. And he fully recognizes, I think, that he gives up some value on the back end, but he's okay hitting doubles or triples versus trying to get that grand slam. So he's okay not being Mark Zuckerberg. He's okay, selling businesses for, not inconsequential amounts of money, but still, growing a business, selling it for a decent amount, putting that money in his pocket, living off of that for a while still saving it and growing the next business.
More power to him. I mean, it takes a certain personality to figure that out and be so self-confident that I can step up to the plate and hit another double or triple every time I get up there. That's great.
Yeah, and it's a skill. Look, I don't have that skill, and I don't know how many people do have that skill where he literally can look at the marketplace and say, I think that's a market where I can create a company that's going to be worth $40-50 million in 4 or 5 years.
Mm-hmm.
And that's what he wants to do, and he's done. He keeps doing it.
That's great. Scott, I want to be respectful of our time. So anything we didn't cover that you'd like to put into the conversation?
No, I think we've covered actually a lot.
Yeah, we did.
I think we've covered M&A. We've talked about rep and warranty insurance. We've talked about startups. We've talked about setting up corporations. we haven't got into shareholder agreements and provisions and operating agreements. We could always do that later, but we've covered it all.
Cool. If somebody wanted to get in touch with you, what's the best way to do that?
Happy to call the office or email me. I'm online. I'm pretty easy. My email is smautner@homlegal.com, and the office is 914-686-4800, and just ask for me.
Great. I will put your email and phone number in the show notes. So if anybody wants to reach out to you, they can do that. And I'll say that if anybody's interested in being on this show, telling me your story, having this conversation, I'd love to speak about it. I'll put my contact info in the show notes as well. And Scott, thanks very much for joining us today.
That was fun. You're welcome.
Great. Until next time, I'm Gordon Coyle. Be well.
That's it for this week's episode of the New York Business Leaders Podcast. Be sure to subscribe so you don't miss next week's episode. In the meantime, find more interviews and resources at nybusinessleaders.com.